Now today's question has been sent in by Akshay, who says that he's been following value research and you for over 20 years now. He started his SIP journey in 2008 and has been an equity investor since then. He has a question regarding fund size. He says, I currently own PPFAS and quant small cap funds. I've been happy with two completely different styles of money management. But now, as both the funds have grown in size, does it make sense to keep expecting 15% plus returns over the next 5 years from them, or smaller AUM funds like Helios, Flexi-Cap and 𝗔𝗯𝘂𝘁 focused equity make more sense?
It's actually three questions. One is that is 𝗥𝗲𝘀𝗲 Flexi-Cap fund and quant small cap fund, is it vulnerable to turning big? And they are not. Both are following a strategy where the scale of their investment or the size of their investment is not going to be a very serious impediment. Maybe at some point quant small cap might face, but not as of now in the way they are managing, or their scale is not turning against them. Simply because the kind of stocks they are the portfolio thinking that they have, and the way they are being managed and the way it is allocated. Second is that should one expect 15% return in the next 5 years? I don't know. In fact, one should be very flexible about the return, and one should be flexible about your expectation in line with the inflation. If in the country, or if in India, we have interest rates which is at 5-7%, if we have inflation which is lower than that, and if you get 10% return, that could be a handsome return. If the inflation is 20% or 10%, and if you earn 15%, it may not be a good return. So you have to see it in terms of what is the risk-free return, what is the inflation, what is the cost of doing nothing and still your money depreciates. These are your benchmark, these are your threshold, these are your reference point. Any speed is not good. You have to see that what is good enough. And that good enough can change depending on the inflation and the risk-free return. So with that in mind, I think, even if you will, I would expect that, the outlook for equity or high quality companies in the country, and a thoughtful fund manager who is able to buy it opportunistically when things are attractive and able to sell things, there will be a value addition of all that, less expenses, will translate into, some kind of inflation premium. Some kind of inflation premium, and that could be 20%, 25%, 50%, because there will also be an element of luck here. So that is the second question. Be flexible about your expectation from equity. Sometimes 12% could be good, sometimes 15% could be good, sometimes 20% may not be good enough if we are in a very weird economy. Third is that, he's asking about two relatively new funds, Helios Flexi-Cap and 𝗔𝗯𝘂𝘁 focused equity. In one of our shows, I have spoken to both the fund managers, and that in our series called Money Masters. I quite like their approach. They are quite differentiated approach. It is getting reflected in their portfolio. And both funds have they have limited history, and they are demonstrating it well. They have very credible history elsewhere. In their older jobs, in their older fund management roles, they have done exceptionally well. So reason to be hopeful, give them some time and try out your investments a little bit here. But first, in light of the first two questions, give them some time, and they look very promising. Helios as well as 𝗔𝗯𝘂𝘁 look very promising.